Okay, class, I'm back with you, and I want to look at Chapter 13, SE5. Okay, so let's review a little bit about preferred stock. Okay, you may remember from your reading, I hope, that preferred stock is called preferred because it will get a dividend paid before there is money available to pay the common stockholders. What's not preferred about it is that it doesn't vote. It also doesn't really have the ability to run up in value like common stock does, because since you've promised a certain amount of a dividend to be paid, then that means the value of that stock only changes as investor expectations change for their investments. Okay? So I'm looking at SE5. Mazurka Corporation has 2,000 shares. Let's just put some basic data down. 2,000 shares of preferred stock. It's $100 preferred stock, which means basically they got paid $100 or very close to it. That's its face value. And it's 8% cumulative. What that means is that it's going to pay $8 a share. See, 8% of $100 is $8 a share is what it's going to pay. Now, if you don't declare any dividends, you don't have to pay it. But when it's cumulative, that means when you do start paying dividends again, you have to catch it up. If it was non-cumulative, then that means if you have a year where you didn't make any money and you can't pay any dividends, you just won't. Okay? They're just gone. Then we also have, on common, we have 40,000 shares of dollar par value, common stock outstanding. Okay, outstanding. So what we need to do is they're going to tell us a total value of dividends that get paid, and we have to sort it out between the preferred and the common. So first, I need to set up a nice worksheet for this, and this is exactly like the worksheet that companies actually keep in their company. Okay? So I've got preferred stock, dividends, and I've got the amount and what that works out per share. I've got common stock, dividends, and I've got an amount we're going to pay out, and I'm going to notate what that worked out to be per share. And then I've got to keep track of total dividends to make sure I don't give out too many dividends. Okay? Total dividends. So, in 2013, none. The board of directors declared no dividends. In 2014, we are going to pay 2013 in arrears, and okay, let's see what that'll work out to be. $8 a share, okay, times 2,000 shares. $8 a share times 2,000 shares. So we're going to end up paying $16,000. Okay, well, that's from 2013. That's catch-up. Now we're going to pay 2014. How much did they say? 40,000. We need to make all this add up to 40,000. Okay, so it's 16 for 2013 in arrears. Now, 2014 current preferred dividends. Also $8 times 2,000 shares. That's why it's preferred. It gets a set amount. Okay, so there's another 16,000. So 16 and 16 is 32. We need to spend 8 more thousand on dividends to get to 40. Okay, those are going to go to common. Common. Okay, so the total is going to be 8,000. What would that work out to be? 8,000 shares, $8,000 divided by 40,000 shares. Guess what? It's 20 cents a share. Everybody see that? $8,000 divided by 40,000 shares is 0.20, 20 cents a share is what the dividends work out to be. Then in 2015, they pay $80,000. Okay, well here's where you're going to see how things change for common and preferred shareholders. In 2015, we're all caught up. We don't have any dividends in arrears on the preferred, so we're going to pay 2015 preferred, 2,000 shares at $8 a share, $16,000, $8 a share. Nothing changes. Okay? But guess what? We're going to pay out the total of $80,000 this year. So how much is going to go to common? Holy moly. 64,000 is what it will take to get up to 80,000. Okay, 64,000. Well, let's see what that works out to be. If I put 64,000 right here, and I've got 40,000 shares, $64,000 divided by 40,000 shares works out to be $1.60 per share. So they've had quite a dramatic increase over the previous year. Okay? So that's how that works when you have preferred shares and common shares. Okay, the next problem that I would like to do is I would like to talk about stock dividends. Now, stock dividends are an interesting beast for us. We don't issue any cash. We just issue stock. Okay? However, we do record it like dividend. We record it in a stock dividend account, and that will also be closed out to retained earnings, just like we do with our other. Let me get some better paper on this. That's bleeding through too much. I'm trying to use scratch paper so you can see the typing on the back side for the printing. Okay, so I'm looking at SE11. So we pretend like it's cash. And why would we give? Why would we give people a stock dividend? Well, because if our stock is kind of going up, then if they have more shares, they're going to get a bigger bump. Or if we pay dividends, they're going to get a bigger bump. But maybe we've got a lot of net income, but we don't have very much cash. And if you'll remember, lots of times we have a lot of net income and very little cash because maybe we're trying to expand and we're building new buildings and buying more equipment. So we're cash poor, but we actually have a good net income. So our stockholders, they want something. So sometimes we use stock dividends. Looking at SE11, on February 15th, my corporation's board of directors declared a 2% stock dividend applicable to the outstanding shares of its $10 par value common stock, of which 400 shares are authorized, 260 are issued, and 40,000 are held in treasury. Okay, well, if I've got 260,000 issued, I need to subtract the 40,000 shares of treasury stock to get the outstanding shares. So in other words, I'm only going to pay stock dividends. I'm only going to calculate stock dividends on outstanding shares, which is just 220. Okay? Okay. We're going to do a 2% stock dividend. And let's see. So I'm trying to figure out how many shares are outstanding. Okay, so here's how I want to do it. We've got 220,000 outstanding shares, and if we're going to give a 2% stock dividend, it's based on 2% of the number of shares outstanding. So 0.02 times 220,000 is 4,400. So we are going to issue 4,400 shares. We're going to issue 4,400 shares for the stock dividend, and currently it's trading at $15 a share. So that means that this stock dividend, in theory, this stock dividend is worth $66,000. Do you see that? A market value of $15 times 4,400 shares. So this is the value of the stock dividend that we're going to record. All right? So on February 18th, or February 15th, we're going to declare it. So we will debit stock dividends for $66,000, and we will credit a new account, common stock distributable, because we're not writing a check. We're only going to do that for 4,400 shares times par value of $10 a share. Because see, we're actually going to increase the common stock that's out there. And then the remaining account is additional, paid in capital common stock. Okay. So see, the extra $5 above par value goes into additional paid in capital, just like we were selling the stock. Okay? Then on March 15th, or March 1st, there's no entry required, right? Because they're just trying to figure out who owns the stock. And then on March 15th, we will actually issue the shares to everybody. And all we do is take it out of this liability account called common stock distributable and put it into common stock. So we now have more shares outstanding. We now have more shares outstanding. We don't have to do anything with that extra $22,000. We'd already put an additional paid in capital. Then the problem tells us that on March 30th, we declared a 50 cents per share cash dividend. Well, here's what's interesting. Here's what's interesting. We have more shares outstanding now. Okay? We have more shares outstanding now. So if it's 50 cents a share, it's now 50 cents times 220,000 shares from when we started this problem, plus the 4,400 shares we just issued. Don't get confused and add in the dollars. 220,000 shares, 2% stock dividend, 4,400 shares. It worked out to be $44,000 of par value. These are dollars, but the 4,400 is the shares. So 50 cents times 224.4. Okay, that would work out to be 112.2. And of course, we're actually going to pay that, but right now we're just going to set it up as dividends payable. And it would be paid at a later date. Okay? All right, awesome. Thank you.